Imagine a legacy physical clothing retailer posting a 17% comparable store sales increase right now, like in this macroeconomic environment.
Yeah.
And we're not talking about a software company, not some, viral direct-to-consumer brand.
Right.
We're talking about a physical, off-price department store with sliding glass doors and shopping carts. 17%.
It forces you to double check the earnings release.
Yeah, you think it's a typo.
Exactly.
Yeah.
Because in a mature, heavily saturated industry where a 2% gain is considered a massive victory, 17% is a structural anomaly. It just doesn't happen.
It really doesn't. So welcome, everyone, to a special extended deep dive of Talk Tickers. We are tearing into the Ross Stores Q1 2027 earnings call today.
Huge quarter.
Massive. We've got the transcripts, the analyst notes, the historical data, and our mission today is really to just cut through the Wall Street jargon and figure out exactly how Ruts delivered this 40-year high performance.
Yeah, and we want to get to the actionable bottom line for you, the retail investor, whether you're holding the stock or just considering it.
Right, because generating over $1 billion in new sales in a single quarter is just staggering.
It's a lot of money.
It's a ton. So let's hit the headline numbers first. Total sales grew 21% to $6 billion.
Right.
But I look at this and I immediately have to ask, where is that coming from? Because when you see earnings per share jump 37% to $2.02, my immediate cynical assumption is that we are just looking at a cocktail of financial engineering.
Oh, like share repurchases masking bad operations.
Exactly. Like, are they actually selling that much more clothing, or is this a magic trick?
It's the right instinct, honestly, because we see that exact sleight of hand across the retail sector constantly.
All the time.
Right. A company shrinks its float to inflate those per share metrics while their actual unit volume is, declining. But the data strictly refutes that here.
Okay, so it's real growth.
Completely real. The EPS growth is backed by pure operational leverage. They were physically moving that much more product, which is why that 17% the comparable store sales metric is the linchpin of this entire quarter.
Right. And for those of you listening who might be new to retail analysis, comps are the holy grail. It strips out the revenue from brand new stores.
Right. It's just the stores that were already open last year.
Exactly. They didn't just buy growth by aggressively opening new boxes. The stores that were sitting there last year processed 17% more volume.
And, doing a 17% comp in apparel, almost unheard of.
And the flow through on that volume, that's what really caught my eye in the transcript. Operating margins expanded by 120 basis points.
Which brings them up to 13.4%.
Right. And again, translating that Wall Street jargon, a basis point is just 1/100%. So they improved margins by 1.2%. And when you think about the mechanics of off-price retail, flow through is everything.
It's the whole ball game.
It really is. Think of it like a commercial airline flight. Once the airline has sold enough tickets to cover the jet fuel, the pilots, the lease on the actual plane.
The fixed costs.
Right, the fixed costs. Once those are covered, every additional ticket sold for a middle seat goes almost entirely to the bottom line.
Yeah, pure profit.
Exactly. And Ross essentially just filled every single middle seat in their fleet. Their fixed costs, the rent on the big box stores, the base lane utilities, the store manager salaries, all of that was already paid for.
That airline analogy is exactly right. Bill Sheehan, their CFO, noted that they typically expect every single point of comparable store sales growth to be worth like 10 to 15 basis points of margin flow through.
Okay.
And this quarter, they hit the absolute high end of that range. They got massive leverage on occupancy costs. Cost of goods sold actually dropped. It was 145 basis points lower. Yeah. And merchandise margins improved by 85 basis points. So even with the necessary bump in variable costs, because, you have to pay more hourly labor to physically unload and merchandise a 17% increase in inventory.
Sure, yeah, you need bodies in the store.
Right, but the fixed cost leverage overpowered everything else.
Which results in just a tidal wave of free cash flow. Net income hit $650 million.
Up from $479 million last year.
That's a huge jump. And going back to the buyback point, they aren't just hoarding this cash. They repurchased 1.5 million shares for $319 million.
Yeah.
So if you're holding this stock right now, you have to look at that new $2.55 billion authorization as a massive structural support for the share price.
Absolutely. They remain on track to retire 1.2 $5 billion in stock during 2026 alone.
Which creates this beautiful self-reinforcing cycle for the shareholder.
It really does. They're funneling that operational outperformance directly into reducing the share count.
Yeah.
And that structurally elevates the floor of the stock price.
Right.
But to understand if that operational outperformance is durable, if it's going to last, we have to really dissect the story behind the numbers. Who is walking through the doors and what is driving that consumer behavior? Because as we know, not all sales growth is created equal.
Exactly. When a retailer posts a massive jump in revenue right now, the very first question I have is always pricing power versus inflation.
Right. Did they just hike prices?
Exactly. Did they just pass along a 15% price hike to cover their own supply chain costs? But the Q&A session on this call was incredibly revealing. Tracy Kogan from Citigroup really pressed management on the basket metrics.
Yeah, that was a great question.
It was. And the response was that the average basket grew only slightly, and units per transaction completely flat.
That is the most critical data point in the entire transcript, I think.
Totally agree.
The 17% comp wasn't driven by massive inflationary price hikes. And it wasn't consumers suddenly buying 10 shirts instead of 5. The growth was driven almost entirely by foot traffic.
Force wings.
Door swings, a double-digit increase in raw customer count.
So more individual human beings are making the deliberate choice to get in their cars, drive to a Ross store, walk in, and check out.
Yes.
And the demographic breakdown of who those people actually are, that's what shifts this from just a good quarter to a potential paradigm shift.
Right, the aha moment.
Yeah. The growth was broad-based across all income levels and geographies. Like the Midwest performed best and California stayed right on the chain average. But the real story, the thing that blew me away, is the 18 to 24-year-old demographic.
Gen Z.
Gen Z management specifically called out third-party credit card data showing Ross is outperforming virtually everyone with Gen Z.
Which is a demographic that traditional department stores have been desperately trying and failing to capture for a decade.
Yeah, they've been bleeding that demo.
Right. Ross hasn't abandoned their core middle-income family shopper, obviously, but they've added this entirely new, younger cohort. And this cohort is treating the off-price model as like a high-frequency treasure hunt.
But okay, let me challenge this premise for a second.
Good for it.
You say this is durable demand from Gen Z, but Gen Z is notoriously fickle.
True.
Right now, going to Ross and finding some discounted name brand hoodie, it's a massive TikTok thrift haul trend. It's a viral behavior.
Yeah, the haul videos.
Exactly. So what happens in 6 months when the algorithm moves on, or when the novelty of the treasure hunt wears off? How do we know this isn't just a fleeting fad masking a temporary bump?
It's a very fair concern. And look, if Ross were just accidentally catching a viral wave without adapting their business, I would agree with you.
Right.
But the underlying merchandising data shows a deliberate structural adaptation to keep this customer sticky. Look at the performance of their cosmetics category.
Right, the beauty segment.
Yeah. When Deutsche Bank's Christina Katai asked why beauty was such a standout, management revealed that they didn't just allocate more square footage to cosmetics. They didn't just build bigger end caps or displays. They completely overhauled the assortment.
What did they change?
They tapped into the exploding Korean beauty market.
Oh, wow. K-beauty is huge.
Huge. They brought in fresh, trending brands and dramatically increased sales productivity per square foot without needing to expand the actual floor space.
Okay, so they're paying attention.
Exactly. They are actively merchandising to the Gen Z palette. They are securing the exact products that demographic is searching for, rather than just crossing their fingers and hoping they wander in for cheap socks.
So they're optimizing the existing floor space for higher turnover in trending categories. But doing that requires an incredibly agile supply chain.
Very agile.
Which brings us to the pack-away strategy. Because looking at the data, we see that consolidated inventory is up 12%. But pack-away inventory dropped to 36% of the total, down from 41% last year.
And for anyone modeling Ross's cash conversion cycle, that pack-away metric is vital.
Can you explain pack-away in plain language for the listeners?
Yeah, of course. So the pack-away strategy is essentially Ross acting as a liquidity provider for the broader apparel industry.
Okay.
Say a mainstream brand miscalculates demand. They produce way too many winter coats and suddenly it's February and they need to liquidate them fast.
Right.
Ross buys them for pennies on the dollar, They physically pack them away in their massive distribution centers, and they just sit on them for 9 months until the following fall.
Wow.
It requires immense capital formatting, and obviously it assumes fashion risk, which is why they primarily use it for basic silhouettes and recognized name brands rather than hyper-trendy fast fashion.
Right. A plain black North Face jacket is going to sell just as well next November as it would have this November.
Exactly.
And if packaway is their primary mechanism for securing premium margins, isn't a drop from 41% down to 36% a red flag? Like, are they losing access to those closeout deals?
It's the exact opposite, actually. It's purely a function of their current sales velocity.
Oh, because they're selling it too fast.
Yes. The absolute dollar amount of inventory is actually up 12%. But because they are churning through current in-season merchandise, so rapidly driven by that double-digit traffic increase we talked about, the active, on-floor inventory is making up a larger piece of the overall pie.
Oh, I see.
They aren't starving for closeouts. They are just feeding the beast of immediate consumer demand so fast that the ratios have shifted.
And their access to those closeouts has never been stronger. Management literally stated they're getting first calls on opportunistic deals and canceled orders.
Which is huge.
It is, and I don't think casual observers realize how cutthroat the vendor ecosystem actually is.
Oh, it's brutal.
It is brutal. When a mainstream full-price retailer panics and cancels a $50 million order, that vendor is suddenly facing an existential liquidity crisis.
Yeah, they've got factory bills to pay.
Exactly. They need to move millions of units instantly. They do not have time to negotiate with 5 different buyers.
No, they don't. They pick up the phone and call the buyer who has the open-to-buy budget, the warehouse capacity, and the track record of just cutting the check immediately.
Right.
But because Ross is demonstrating such outsized growth and throwing off so much free cash flow, they are at the very top of that call list.
The first call.
The first call. They get to cherry pick the premium brands, the best size runs, and the highest quality goods before the rest of the off-price market even knows the inventory is distressed.
It's a brilliant flywheel effect.
Yeah.
CEO Jim Conroy mapped it out perfectly on the call.
Yeah, the marketing flywheel.
Right. He said better marketing drives the initial foot traffic. Then, once they are in the door, those first call premium assortments convert the shopper into a buyer.
Right, because they see the good stuff.
Exactly. And the resulting sales fund more store labor to keep the massive boxes clean and shoppable, which, let's be honest, has historically been a weak point for off-price retail.
Yeah, the messy racks.
The dreaded messy racks. But a clean, well-stocked store drives repeat visits, which funds more marketing, and the cycle accelerates. And the kicker. They achieved all of this without spending more on marketing as a rate of sale.
Which really highlights their operational discipline. However, and we should be fair here, management was very careful to note 2 specific one-time tailwinds that definitely juiced this specific quarter.
Right, the macro boosts.
Yeah. First, they planned the first quarter incredibly conservatively, which left some pent-up demand on the table. And second, the timing and magnitude of higher tax refunds compared to last year.
Right.
That undeniably put more discretionary cash in their core demographics' pockets right when the spring assortments were hitting the floor.
But let me play devil's advocate. If you strip away the tax refund bump and the conservative planning, does the thesis actually hold? Because if this entire quarter was just subsidized by the U.S. Treasury via tax refunds, the back half of the year is going to be brutal.
Management addressed that head on. Even after the peak tax refund season subsided, they maintained solid mid-teen comps for the balance of the quarter.
Oh, wow. Okay.
Yet the underlying run rate, independent of the calendar shifts and the refund checks, remains incredibly strong. This is durable demand, not a fluke, which is exactly why they approach the forward guidance with such an aggressive posture.
And the guidance is really where this transitions from a story about a good quarter to a story about a structurally transformed company.
Totally agree. Let's get into the forward-looking numbers.
Let's do it. For Q2, they are projecting comps up 6 to 7%, EPS between $1.85 and $1.93, and operating margins holding strong around 12.8 to 13%.
Yeah.
And then they raised the full year 2026 comp guidance to that same 6 to 7% range.
Which is remarkable when you consider the baseline. They are projecting 6 to 7% growth on top of a very solid 5% gain they posted last year.
Right, the 2-year stack.
Exactly. In retail, compounding comps at that level over a 2-year stack is exceptionally difficult.
It shows an unbelievable amount of swagger from the executive team.
Swagger is the perfect word.
Because usually retail management teams are masters of sandbagging.
Oh, absolutely. They love to lower expectations.
Right. They will find any excuse, weather, calendar shifts, minor supply chain hiccups, just to lower the bar so they can step over it later and look like heroes. Daring to guide a 6 to 7% comp on top of last year's gains means they see something in their internal telemetry that gives them absolute certainty.
It speaks to Jim Conroy's philosophy on managing the business right now. When an analyst asked how they plan to lap these massive comps next year, Conroy essentially said that worrying about tough comparisons is the wrong framework entirely.
Interesting.
Yeah. They believe they are in the early innings of a long-term cultural and operational shift. The underlying KPIs, the geographic strength, the sheer volume of new customer acquisition are so robust that they aren't managing for defensive comparisons anymore. They are managing for absolute growth.
But they did flag some very real macro headwinds that we need to talk about. Specifically, fuel and freight.
Right.
Elevated fuel prices are a double-edged sword for a company with a logistics network this massive. It hits them on domestic trucking costs, moving goods from the distribution centers to the stores, and it hits them on ocean freight rates for their imported goods in the back half of the year.
And those freight costs are heavily baked into their back half guidance. But, this is where the off-price model reveals its greatest strength. It is a naturally hedged, counter-cyclical business.
Explain that.
Well, when inflation spikes and gas prices soar, the consumer's wallet is squeezed. A traditional full-price mall retailer watches their foot traffic just evaporate as discretionary income dries up.
Because people stop buying $70 shirts.
Exactly. But for Ross, that exact same macroeconomic pain acts as a catalyst. Middle-income and upper-middle-income shoppers trade down. They still want the name brands, but they can no longer justify the department store markup, so they flood into Ross.
That's a fascinating dynamic. The very inflation that drives up Ross's internal freight costs simultaneously delivers them a massive influx of new, wealthier customers.
Yeah.
And it gets even better on the supply side, right? Because when the macro environment gets choppy, full-price retailers panic and aggressively slash their inventory orders.
Exactly. And those slashed orders create the exact distressed closeout inventory that Ross's buyers thrive on. So a deteriorating macroeconomic environment gives Ross both a wider pool of customers trading down and a deeper, cheaper pool of premium inventory. It is an incredibly resilient architecture.
Which is why they are stepping on the gas with their real estate strategy. They aren't just squeezing more volume out of existing boxes, they're targeting 5% unit growth this year.
Which is about 110 new stores.
Right. Roughly 85 of those will be under the core Ross banner and 25 will be DD's discounts.
And we should clarify why that dual banner strategy is so vital for their growth.
Yeah, please do.
So DD's discounts operates at a slightly lower price point and targets a different demographic profile. They often anchor in different neighborhood strip centers than a traditional Ross.
Okay.
It allows the parent company to densely saturate a geographic market and capture a wider spectrum of household incomes without cannibalizing their own flagship stores.
Makes total sense. And speaking of geographic markets, the expansion in the Northeast is a massive focal point. They exited 2025 with 12 stores in the New York area, and they are pushing hard to add more.
Yeah, New York is tough.
Now, operating a massive, high-volume discount box in the Northeast is notoriously difficult. The real estate is incredibly expensive. The logistics of navigating dense urban and suburban traffic with massive freight trucks is an absolute nightmare, and the labor costs are sky high.
Right.
You have to move a staggering amount of volume just to break even on the rent.
Which is exactly why the commentary from their COO, Michael Hartshorn, was so significant.
What did he say?
He stated that these new Northeast stores are far exceeding their underwriting pro formas. Yeah. When they model these stores, they bake in those exorbitant rents and complex logistics, and they set a very high bar for the required sales volume. Hartshorn is signaling that the consumer demand in these new, non-legacy markets is so intense that they are blowing past those conservative models. The concept works far beyond their traditional strongholds in California and the Sun Belt.
So, if the boxes are wildly profitable and they are exceeding pro formas in the toughest real estate markets in the country, why limit unit growth to 5%?
That's the billion-dollar question.
Right. If I'm an investor, I want them opening 200 stores, not 110. Why not accelerate?
Because hypergrowth is the silent killer of discount retail.
How so?
Opening a store isn't just signing a lease and turning on the lights. You have to integrate that box into a highly complex, finely tuned logistics network. You have to staff it, manage the pack-away flow, and ensure the localized merchandising is actually accurate for that specific zip code.
Oh, I see.
If you outrun your supply chain, your stores become disorganized, inventory piles up in the wrong places, and the brand equity is destroyed. Management is fiercely protective of their operational discipline.
Okay. It makes sense.
However, they did concede that if a macro event occurred, like, say, a major competitor filing for bankruptcy and suddenly vacating 50 prime real estate locations, they have the capital and the agility to accelerate that target and snap up the leases.
So they're disciplined but opportunistic.
Exactly.
Which brings us to the bottom line. We've dissected the 17% comp, the Gen Z demographic acquisition, the pack-away logistics, and the aggressive guidance. For the retail investor modeling this out, what is the ultimate takeaway? Is this a bullish or bearish signal?
The takeaway is unapologetically bullish.
Unapologetically. I love it. Why?
Because it's driven by a fundamental cultural shift within the executive suite. During the Q&A, Jim Conroy made a really fascinating admission. He acknowledged that the company has actively shifted its internal culture from a risk-averse defensive posture to a highly entrepreneurial offensive one.
Interesting. And you can see that offense playing out right on the racks. They are actively architecting a good, better, best pricing strategy now.
Yeah.
In the past, Ritless was hyper-focused on the good, meaning the absolute lowest price for an acceptable item. Now, because they've captured this new demographic and are getting first call on premium brands, they are stretching their pricing architecture upward.
Right. They're not just selling the cheapest thing anymore.
No, they are successfully selling better and best tier products at higher absolute price points. And the customer is willingly paying up for those premium brands, which drastically improves the margin profile without alienating the core bargain hunter.
And when you layer that pricing power over their long-term financial algorithm, the math just becomes undeniable.
What's their algorithm?
Their stated historical model is 5% unit growth, plus 3 to 4% comparable store sales, plus 2 to 3% share repurchases equals double-digit EPS growth. But right now, they are vastly outperforming the comp variable. They aren't hitting 3 to 4%. They just hit 17 and are guiding to 7. They are breaking their own algorithm to the upside.
So to make this actionable for you, the listener, if you are holding the stock right now, you let the machine work.
Just let it run.
Exactly. This isn't a speculative tech valuation built on a 10-year forward projection. This is pure, unadulterated cash flow being generated today, backed by expanding operating margins and a sticky, newly acquired demographic. Let the buyback program quietly retire the float and compound your ownership.
And if you are on the sidelines, if you're hesitating because of the macro environment or the fears of inflation and freight costs.
Yeah, what's the play there?
The data from this quarter proves that Ross is an all-weather vehicle. Don't let the fuel cost headwinds scare you. It is a defensive asset that plays an aggressive offense when the rest of the retail sector is retreating.
Which leaves us with one final provocative thought. We've spent this entire deep dive marveling at Ross's gains. The massive influx of Gen Z shoppers, the billions in new revenue, the unprecedented access to premium first call inventory.
Right.
But retail is fundamentally a zero-sum game. Every single dollar spent at Ross is a dollar aggressively ripped out of another retailer's register. So if Ross is hoarding all this premium inventory and capturing all this young demographic traffic who is bleeding,
that's the real question.
Which traditional full-price mall retailers are actively watching their future customer base walk out the door straight into an off-price warehouse?
Somebody's paying for this growth.
Right. The unprecedented rise of Ross isn't happening in a vacuum. It is the loudest, most undeniable symptom of legacy, mainstream retailers silently losing their grip on the American consumer. Think about who is on the losing end of that exact transaction.
It's a scary thought for the mall brand.
It really is. Thank you for joining us on this deep dive into the numbers. Keep your eyes on the tickers, and we will catch you next time.